Can you see the next this thing on this thing? Can you see my slide?
Yes.
Okay.
Yes.
So what we have done so far, we have covered equity. Okay, and I have taken you through one of the fund scheme that is called Nippon and seen where they are all invested and got into various kinds of details. So I'll be sharing a project for or an assignment which you people have to do. So this will also carry maybe about 15 marks. I'll just think about that and I'll share the assignment with along with the marks, where you have to do an analysis of the equity mutual funds. So there are a lot of mutual funds which you can see on the screen. So you can do analysis. You can choose the top 5 mutual funds, okay, and or top 3. If you have done a deep analysis, you can just choose 3. Otherwise, if the analysis is short, then you can make it 5 or even more. Okay, it's your choice because this carries either 10 marks or 15 marks. Okay, so which I am going to share shortly. What all supposed to you are supposed to do in your assignment, but you have to make analysis, and the analysis will be based on which top 5 mutual funds you think are the best and why you should put money there. Okay, and talk about these mutual funds. Okay, so now I'll be sharing that assignment details maybe in a day or two. So after that we can have a discussion. Okay, fine. So then we move on to the next one, which is debt. Of course, I was supposed to do this offline on Monday, but I'm starting a little bit. Okay, so we'll do it for another 15-20 minutes. Okay, fine. So these are called debt mutual funds. Okay, so here the fund manager is not investing into equities, he is investing into debt. That means fixed income securities. Okay, so Shishti, or can you read these mutual funds? What are the various schemes?
Yes, so for debt mutual funds, there's low duration, long duration, corporate bond, fixed maturity, money market fund, short duration, dynamic bond, credit risk, interval plans, overnight fund, medium duration, gilt, floater, ultra short duration, target maturity, medium to long duration, gilt fund with 10-year, constant duration, banking and PSU fund, and liquid fund.
So these are, the how many? I mean, can you count them, Shishti?
20.
20. So there are 20 subcategories or of these mutual funds. Okay,
So 19 actually.
19. Okay, 19. Okay, and this is there is a word which has been constantly repeated in most of the mutual fund. What is that?
Duration.
Absolutely. So duration is a word which has been used quite commonly with most of the categories. So what is duration? Okay, so duration is very important. Um, like suppose you're going to invest, the least risky of the fund would be liquid funds. Okay, fine. Here, if you don't want to take at all any risk and you want to invest into a fund which is going to invest your money into fixed income securities, so you should choose a liquid fund. Okay, where the duration has no meaning as such. Okay, so just read this first. Little bit of idea about this mutual fund. Just read what is liquid fund.
Liquid fund. These mutual funds invest in bonds and money market instruments with maturity no longer than 91 days.
Okay, further.
Suitable for investors who want to invest for very short term and are looking for alternative to bank account/deposits.
So basically, liquid funds are basically investing into some instrument whose maturity is like 91 days or less. Okay, like treasury bills or CP series. I don't know whether you have know these kinds of instruments. I'll talk about them. So these are only invested for 91 days. Of course, they go and invest into these schemes for 91 days, but they always remain invested. So if you buy a mutual fund, you are going to get return. So you are not invested for 91 days. They are going to invest your money for 91 days, and as soon as the 91 days are over, they are going to again invest into a particular category of this instrument. Okay, so this is like just like a bank account. Okay, in a bank, how much return you get in a savings account? Seriously, if you park your money or anyone, how much kind of a return you get?
Like,
Huh?
so 2.2 to 3%.
Like 2 to 4,
Max 3.
yeah, 2 to 4% kind of a thing. So liquid fund is like alternate to a bank account. So let's understand what is a liquid fund a little bit more. So just download the data, okay, and see how much return they have given. So they are liquid funds. Why they are called liquid? Because if you are investing into them, you can convert your money very soon into cash and disinvest your money. So these are liquid funds. Okay. So I'm just deleting this. The category is liquid, so this is all liquid. So I know that. So for my further analysis, I'm just going to put them here like this. Okay. And say Control T. Okay. And put this thing. Okay. Now, and then I just sort them on the basis of 1 year. Okay, because 1 year is quite good amount here. It's not like equity, so 1 year should be a proper kind of a analysis. How much return you're getting in 1 year time frame. Okay, so I'm just putting again a cursor here for 1 year. Okay, so and because these funds are giving a very low return, so what I'm doing is that I'm going to make it up to 2 decimal places to make it more relevant. Okay, so this is up to 2 decimal places. So which fund in 1 time year frame is giving the, okay, I think this is not been done. Okay, this is also done. Let me see if there is further scope here. Okay, even this is, or I'll make it a decimal places only. Okay, let it be up to 1 decimal place, because so which fund has given you the maximum return in 1 year time frame?
Franklin India Liquid Fund.
Okay, how much? 7%. Okay, so that means this fund has given almost like 7% return in 1 year time frame. So if you put your money in a saving account, how much you get? 2 to 3%. Okay, but if you invest your money in a liquid fund, you get almost like 7%. Let's look at a 3 months or 6 months. So I put it 0 here. So in 3 months time, in 6 months time, they have given 3.3%. Okay, even less than 7%. So annualized will be 6.6%. So these are called liquid funds, where you can invest your money and you will get only on an average you will get a 1 year a 7% kind of a return. If you see 1 year, they're giving 7%. In 2 years, how much return you are getting? 7.2%. Okay. So in the last 10 years average, how much you're getting?
So highest being 6.6%.
Highest is by which fund?
Quant Liquid Plan.
Quant liquid. Okay. Okay. So 6.6 is this thing, but here the criteria should not be beyond 1 year or 2 years, because the interest rates keeps changing. Okay, fine. So and nobody remains invested in a liquid fund for 10 years. Maximum would be like for a month, 2 months, or 1 year. So in 1 year time frame, it is giving almost like 7% return. Okay, fine. So it's called liquid fund, where they're going to invest your money in, into certain categories, which we'll talk about. Where they invest, we'll talk about in next class. But maybe I'll just cover this. Let's see, 1 year. So quant liquid fund. Okay, let's see if we can have something. So here, so basically it's a direct fund. How much total? What is the fund size? What is the fund size?
1,514 crore.
The fund size is, that means almost like 1,500 crores has been invested here. And what is the expense ratio?
0.24.
So it is comparatively, it's very less compared to the equity. Now, just to understand, what is the expense ratio? So we just go to the chat GPT where I've done some analysis, because these, companies cannot charge, how much they can charge from the investor is, governed by the SEBI. So they are called SEBI expense ratios, okay? So let's cover this. So this is, just read this, Shrishti.
Yes, sir. SEBI limits on expense ratio. These are caps or slab-wise limits based on scheme type and AUM.
Okay, just
Up
hold
to
on, just hold on, just hold on. There was some error, so I just asked him that, there was some error. So yes, you're correct. So it made some correction here again. Okay, yeah. So this is the final version. So if your AUM bracket is between 0 to 500 crores, okay. So maximum under equity, a fund is authorized to charge 2.25%, including the trail commission, okay. Fine. If the total commission, which includes if you buy from a agent, he is going to also get around 1% or 0.9% or 0.75%, whatever maybe his commission. So altogether, total expenses which can be claimed by the mutual fund scheme has to be 2.25. Okay. So this will be under the regular. Okay. Under the direct plan, it will fall down further. Okay. But there is a cap for the overall. So then for equity, non-equity, how much it is? 2%. Okay. So that means for debt and others it is 2%. For equity it is 2.25. If the fund size is, large, as the fund size grows up, the expense ratio also drops, as you can see. So any fund which is above 50,000, what is the expense limit? Shrishti, just read the last one, above 50,000 crores.
1.05%.
For equity. And for debt?
0.80.
So that means there is an overall cap which has been given by SEBI, the regulator, how much money they can charge. Okay, how much money can be, charged by them for running a scheme. Okay, because they have to pay salary of the fund manager, they have to pay the salary for the office under which they are working, and some stationery and other things. So the maximum expense which they can, charge from the return which you are getting is 1%, 1.05%. It's a large fund. Okay, and for a debt, it has to be less than 0.8%. Okay, fine. So these are various limits. So I'm just moving back to the liquid funds. So in this category, we found that the limit is, we have seen the expense ratios. Okay. Now we will just little bit cover. The class is up to 12:30, I believe. So we'll not go up to 12:30. Okay. So cover a little bit about duration. Okay, and then we'll end up. So because talking about duration, low duration, short duration. So let's say a low duration. Okay. Let's tick this box and see what is low duration. What is written here? Read this. Low duration fund.
These mutual funds select bonds/debt for investments such that average maturity remaining periods of portfolios between 6 to 12 months, Macaulay duration. Shorter duration funds may provide lower returns but are less risky to interest rate changes. Suitable for investors who want to invest for 1 to 3 years and are looking for alternative to bank deposits.
Okay, now, if you see, there is a low duration fund. Okay, there is a short duration fund. There is a long duration fund. Now, if you're invested in a low duration fund, it will be less risky. Now, these funds are also risky. Okay, and I'll tell you how they are risky. But a long duration fund will be the most riskier. So if you take more risk, the chances are that you can earn more. But if you're putting your money in a liquid fund or a low duration fund, then the chances are that you may not lose or you may not gain so much. Okay, because when you invest in a fund, they announce a coupon rate. Okay, like when you buy a bond of a company, they'll say 7% coupon. So that means the coupon is their income. Okay, fine. So now the bond can be for 5 years or 10 years or 20 years. So that will, I mean, impact, that will be called the duration. So let's understand what is duration first of all. So a lower duration fund will be least risky. A longer duration will be the most riskier. Okay. So let's understand about what are these funds. What is this? So I asked the same question from the chat GPT, and let's say what it has said. Okay, just read this.
Macaulay duration and modified duration are closely related measures for bonds' interest rate sensitivity, but they differ in what they represent and how they're used.
Okay,
Macaulay duration.
hold on. So it is interest rate sensitivity. Now it is very difficult to pronounce the word sensitivity. As you also read, then you also made some fumbling. So it happens with everyone. Okay, so there are, two kinds of names: Macaulay duration and modified duration. Now Macaulay was basically, I think, was an American who came up with this idea, and he said there's something called Macaulay duration, and he gave a formula for calculating the Macaulay duration, and then it was further modified, so it was called modified duration. So basically, it tells you about how the bond is going to behave when the interest rate change. Okay, if the interest rate changes, the bond price will also change. Okay, are you knowing that? Have you any idea that when the interest rate, there is an inverse relationship between the price of the bond and the interest rate? If I say that, have you heard that before?
Yes, sir.
Okay, so maybe some of you may not, but anyway, I'll cover that more in detail when we meet on Monday. Okay, I'll give you and show you an Excel sheet if possible today, otherwise on Monday. So, what is Macaulay's duration? Now, suppose I give you an example. Suppose you invest in a bond. Let's not say you have invested in a mutual fund, because mutual fund is also going to buy a bond. Okay, let's say that you buy a bond which has a coupon rate of say 25%. Of course, 25% is very high. Okay, let's say that 25% is a coupon rate. The face value of the coupon is 100 rupees. So that means if you are going to invest 100 rupees, okay, in a company, they are going to give you 25% return on that. So 25 rupees they are going to give every year. Suppose the bond is for 10 years. So in how many years you are going to get your principal back? If you invest, I'm asking this question for anyone to answer. If you have, by simple plain reading, okay, if you have invested in a bond which is giving you a 25% return per annum, and you have put 100 rupees in that bond, in how many years you will recover your principal back? It's a 10-year bond. Okay, in which year you're going to get your money, whole money back? A simple answer, huh? Yeah, you're right.
4 years.
4 years, yeah. So 25 rupees in the first year, 25 in the second year, like this in the fourth year, you're going to get 100. By 4 years, you're going to get 100 rupees, isn't it? But there is some small catch here, because 25 rupees you are getting after 1 year, after 2 years, you're getting another 25. So if you apply a present value formula, so then maybe in the fifth year, somewhere in the fifth year, you will be getting your 100% money back. So if I use a 4 without applying the present value, that means you are losing value, because if you're getting 25 rupees in the fourth year, it is not equivalent to 25 as of today, it will be far less. So if you equate them and find, the present value of all those 25 rupees, then maybe in the fifth year, you may be recovering your 100 rupees back. And if it's a 10-year bond and carrying a 25% coupon rate, the Macaulay duration will be, say, 5 years. Of course, exactly we can calculate. Suppose in 5 years, you get your 100 rupees back. So Macaulay duration will be how much? 5 years. Suppose I give you another example. And now tell me what is the Macaulay duration. Just try a rule of thumb. Suppose a coupon rate is 20% and face value of the bond is 100 rupees. Okay? And the bond is for 20 years. That means if you buy today, you're getting your principal money back after 20 years. But every year you're going to get 20 rupees. So what should be the Macaulay duration? भाई 20 रुपए आपको मिल रहे हैं, 100 रुपए का बॉन्ड है, तो कितने साल में आपका पूरा अमाउंट वापस आ जाएगा जो आपने लगाया है? एज सिंपल एज दैट. पवन, आर यू ऑल देयर? We are still connected?
Yes, sir.
Okay, I thought we are not connected. So I am asking Shrishti this question. Ki suppose you have bought a bond of 100 rupees. It's a 20-year bond. That means you will keep getting the coupon for 20 years, 20%. And in the 20 year, in the last year, you're going to get 120. Okay. So in which year you are able to get all of your principal back?
The fifth year.
Fifth year, okay. Fifth year, 100 rupees, okay, without applying the present value. But it will be somewhere around sixth year, okay. If you calculate exactly, the present value of all that money. So fifth year, let's say it's 6 years, okay. So Macaulay duration is 6. So Macaulay duration, even if the bond maturity is 10 years, 5 years, but by the time, how much time it takes to get your money back is called the Macaulay duration. And more the Macaulay duration, more risky is the bond, more sensitive to the interest rate it is. So just read the definition.
Yes, sir. The weighted average time in years it takes to receive a bond's cash flow, coupons and principals. Interpretation expressed in units of time, it shows the average maturity of a bond's cash flows.
So formula is there. So this is the formula where you can see that Macaulay duration D Mac is equal to the present value of the cash flows divided by the bond price. So this is a formula. Okay, so you don't have to remember the formula at all because the Macaulay duration will be given to you all the time. Okay, fine. So now we come to the second part. We'll understand. We'll do a question so that you can understand to calculate the Macaulay duration. The modified duration. Can you read this?
A direct measure of a bond's price sensitivity to changes in yield, interest rates.
Okay, just hold on. Just hold on. Now, whenever we are looking at a bond or a debt mutual fund, we look at the modified duration, okay, which is more important, which gives you a much better handle because it will give you a direct answer. It gives you a direct measure. So, how sensitive is the bond price to the interest rates? Okay, suppose the interest rate goes up by 1%, the bond price is going to fall. Similarly, if the interest rate goes down, the bond price is going to go up. So, which is beneficial for you? Suppose you have invested in a bond, you would like the interest rates to go down or go up? See, if you have invested in a bond, suppose you have bought a bond of 100 rupees. If the interest rate goes down, and your bond price will go up. So that means if the interest rate goes down, you're going to make money on the bond which you have already invested. Why? I'll just give you a simple reason. Suppose you have invested in a bond at 7%. Okay. Now, and this is a 10-year bond. And if suppose this is marketable, that means you can sell this bond in a stock exchange. Okay. Now what happens? The rate of interest goes down from 7% to 6% in the next year. Now, an investor has two choices, either to buy a bond from the primary market, the fresh bond which is available at 6% coupon rate, or to buy this 7% bond which is available from the stock exchange. If you are holding the bond, you can sell it. But will you sell this bond for 100 bucks? No, because you are getting 7%. The fresh bonds are giving only 6%. So you will sell only if you get a better price for the bond. So 100 rupees की जगह आपको 105 rupees मिल जाए तो आप बेच दोगे, isn't it? Because the interest rates have come down and the fresh bonds are offering a lower coupon rate and the old bonds has still a lot of maturity in hand. Suppose a 10-year maturity period bond and 2 years have only passed, so bond has a life of another 8 years. So somebody wants to sell, so he will sell at a premium, isn't it? Have you got it?
Yes, sir.
Okay, but I'll explain that in more detail through an Excel sheet calculation, everything. Okay, but that will happen on Monday or the day when we are meeting for the further class. Okay, now interpretation. Just read this.
For a 1% 100 basis points change in yield, the bond price will change by approximately the modified duration percentage. in opposite direction.
So basically the modified duration will tell you exactly for 1% change how much will percentage change will happen to the bond prices. Okay, if you know that, and if you think the interest rates are going to fall, okay, then you are going to choose, which bond you should buy: a long duration, short duration, medium duration. Normally a bond which is having a long duration will have a higher modified duration, and chances of making money will be much better. Okay, the formula is nothing but the Macaulay duration itself divided by 1 plus y. Okay, fine. So what we do is we just skip this calculation and see the key difference. Okay, just read this key difference.
Macaulay duration measured in years tells you the weighted average time until cash flows are received. Modified duration, unitless percentage, tells you how much bond price will change given a change in interest rates.
Okay, so now let me just see a numerical example. Okay, read this.
Example, bond, face value is 100 rupees, coupon rate is 10% annually. So coupon is 10 rupees each year. Maturity is for 3 years and YTM is 10%.
So YTM is basically yield to maturity, which means that if you hold the bond for 3 years, then you are going to get 10% return, isn't it? So that is your yield to maturity. Whether, I mean, it will be equivalent to the coupon rate only. Okay. Now the cash flows. Okay. Just read this.
Year 1, 10 rupees, year 2, 10 rupees, year 3, 110 rupees, which is 10 rupees coupon plus 100 rupees principal.
Is that clear? Because in the third year you're getting your principal back. Okay. So now what is the, let's calculate the Macaulay duration. So Macaulay
Present
duration,
value,
yeah, read it.
present value of cash flows using discount rate 10%, PV is equal to cash flows by 1 plus 0.10 to the power t. Year 1 will get 9.09, year 2 will get 8.26, year 3 will get 82.64. Add it all, it becomes 100.
Okay, now the first year you're getting 10 rupees. But what is the present value? By discounting at 10%, the present value is 9 rupees 9 paisa. So that means the 10 rupees received after 1 year is equivalent to 9 rupees today. Now for the second year you're getting another 10 rupees, but the present value should be 8.26. Here you're going to say 1.1 raised to power 2. Year 3 is going to be raised to power 3, but in the year 3 you're getting your principal also back. 100 rupees plus the coupon. So which, suppose you add up everything. So in the year 3 you get all your money back. Is it clear? So now we just apply to calculate what is the Macaulay duration. Okay. So let's now, instead of rule of thumb, okay, let's see what is the exact. So as per the rule of thumb, it comes to about 3 years. But let's see from the formula how much you get. Okay. So if you use this formula, okay, where you take the year 1 and give a weight 1 for the first year, present value. For year 2 you give a weight of 2. So you keep multiplying this and just add up everything and divide by the bond price. Okay, so you will get a Macaulay duration of 2.74, which means it is giving you exact time frame in which you are going to get your principal back. Is this clear? Forget the formula, forget the calculation, the concept. Okay, now what is modified duration? So modified duration, the formula is the Macaulay duration divided by 1 plus y, which is the interest rate. So 2.74 is Macaulay duration divided by 1.1. So you get how much is the modified duration, Shishti?
So modified duration is 2.49.
So now just read this, what is written. So the bond price?
So the bond's price sensitivity about 2.49% change for every 1% change in interest rates. Final takeaway, Macaulay duration 2.74 years tells us on average how long it takes to get back the bond's money. Modified duration 2.49 tells us the price will fall to around 2.49% if interest rates rise 1% and rise around 2.49% if rates fall 1%.
Okay, so this is, now let's just conclude that. Okay, so now we have lots of duration. The fund which is having the maximum duration will give you the maximum profit or the maximum loss. It will give you profit only if the interest rates fall and you're holding a bond fund. Okay, suppose you're holding a mutual fund which has invested in long duration fund, for example, this one. Okay, this one. If you're holding this one, which would have normally a very high modified duration, so a 1% change in interest rate can change the bond value by a certain value depending on what is the modified duration. Suppose the modified duration is 4, that means 1% change can lead to a 4% change in the value of the fund. Okay, either way. So if the interest rate fall, you will get a capital appreciation of 4% along with the coupon. So suppose the coupon is 7 and modified duration is 4. So a 1% change will give you 11% return in that year. Okay, fine. Have you got it? I'll just explain again, so please catch it again. Suppose you have invested in the long duration and you think that the interest rates are going to go down. Now, suppose you have invested in a bond which is having a coupon rate of 7%. So 7% you are getting every year. Now, if there is a change in 1%, the interest rate goes down by 1%, the bond value will go by 4 rupees. So 100 rupees will become 104 rupees. So the bond will be selling at 104. Suppose you sell that bond after a year, after that period, the bond price has changed. So you will get 4 rupees extra plus 7% coupon. So what is the total return? 11%. Have you got it? But in case if it turns out that instead of the interest rate going down, it goes up by 1%. So how much are you going to lose? Just give me an answer. If the modified duration is 4 and the coupon rate is 7%, how much return you are going to get? If you have invested in a long duration fund which carries a coupon rate of 7% and the modified duration is 4 and the interest rate goes up by 1%, how much return you are going to get from this fund?
So 3% then.
Absolutely, absolutely. So just let's see, these funds. Okay, let's download the last thing which we are going to do and see. These are riskier because if the interest rate goes down, then you are going to lose money. Okay, fine. So this is there. Okay, so what I'm doing is I'm just going to delete. And this is long duration. Delete. This is long duration. Delete. Okay. And this is Control T. I could change here. Just have a look here. Fine. So look at the, let's sort it out on the basis of the largest fund. So which is the biggest fund?
Nippon, India.
And what is the total money which has been invested in this fund?
9,533 crores.
And what is the yield return? YTM?
7.25%.
Now, 7.25 is the average coupon duration of all the bonds which have been held by Nippon. Now, here, the bonds can be so many. Okay, so the average duration or average coupon rate is 7.25%. How much return it is given for 1 year?
4%.
So it is less than the coupon rate. So what has happened during this period? Has the interest rate come down or gone up?
Gone up.
Gone up. That's why, if you would have invested in a liquid fund, you would have got 7.25. But you have invested your money in a long duration bond, you can lose money. Okay, so you have lost 3.25 rupees. You were supposed to make at least 7.25, but you have lost 3.25% in 1 year's time because the interest rates have moved up rather than down. Okay, fine. So that's all. Any questions, please? Have you followed that, Shrishti and others? Shrishti, समझ में आया?
हाँ जी sir.
So this is a very tricky topic, okay, because to understand the duration is not so simple. I think I have made it clear today.